How can investors take the returns in their portfolio from unknowable to inevitable? Well, I think most would agree that in the short term, it's incredibly difficult to figure out which way the markets are going to go, what you should invest in order to get short-term returns. And in today's video, we are going to talk about one of the, I would say probably the most important driver in determining the long-term success of your portfolio. And that number is the price that you pay for your investments, which seems simple. However, I think most would be surprised that they don't actually know the price they're paying for their investments. They don't actually know the fundamentals inside of their portfolio. We're going to talk about why that's important and when it starts to matter, because surprisingly, in the short term, it doesn't matter much. So let's look at this chart here. This goes back 40 years, and it tells us, based on the price you pay, what is the expected rate of return that you can get over the next 10 years in the stock market. As you can see, all these dots are clumped together and it starts to go down, right? So the further to the right the dots are, the further down they go, which means the more you pay, which is the left to right section, the lower your rate of return. So if you go all the way to the right, what's that mean? It means you're essentially paying a whole lot and you have a low rate of return because you're paying too much. You go all the way to the left and you're getting the stock market for a great price, which means you have a high expected 10-year rate of return in the market. Okay, great. Well, where are we today? Well, today, based on the S&P 500's current price to earnings ratio of around 27, we are right here on this dot, which is just above zero. Now, this is the 10-year expected rate of return in the market. So that's not good. We've been talking about some other videos that it does not look good based on the price we are currently paying just in the S&P 500, because the S&P 500 is what's called a market cap weighted index. So the very big, very expensive companies make up a large portion of that index. The good news, and we've talked about it in other videos, is there are plenty of other areas that you can invest your money. Go look at those videos and, adjust accordingly. But what's important in this that I want to discuss is what this does not mean for these long-term estimated returns for over a 10-year period, that this is the return you're going to get every year. Okay? It doesn't even mean this is an expectation for next year, because as we're going to look at in our next chart, in the short term, the price you pay actually doesn't matter nearly as much as we think it does, or nearly as much as we think it should. So let's kick off and look at this chart. So this is an upward sloping chart. And if you go from the left side, which is a 0-year holding period, right, all the way to a 12-year holding period, you can see that it starts to go up. Okay, what does that mean? Well, if you go the vertical line from 0 to 100%, this is essentially another way of saying early on in the beginning, let's look to year one, and that looks like that bar is taking us to around 5 or 10%. Only around 5 or 10% of the returns that we get in the market can be attributed to the price we pay. That's another way of saying it is largely unknowable. We can even look at how expensive or how cheap investments are, and it doesn't necessarily guarantee us a positive or a negative experience in the market. Anything can happen in the shorter term, right? And then as we move up on the chart and we go to, let's call it year 5 or 6, now we're closer to 50%, largely a coin toss. And so the price you pay, still around 50%. So not great, but what happens is as we move as long-term investors towards this longer trajectory, you can see that the price you pay makes up 80 to 90% of the returns in your portfolio. And so while in the short term, it's very difficult to predict. Now, this just doesn't mean that price doesn't matter in the short term, but what it means is you have to wait to get the outcomes that you expect in the market, because the short term, there's a lot of noise. But as you move to your long-term horizon as long-term investors, the price you pay is, I would say, the single most important factor in the expected rate of return of the portfolio. And again, this seems highly intuitive, but do you know the price you're paying for the investments in your portfolio? If not, I would say take a look, talk to your advisor, and say, do we know what we own? Do we know why we own it? And hey, let's take a look at this chart and say, if we're paying a lot for these investments, we know anything can happen in the short term, but this puts us down and to the right based on this chart here, right? Do we have a good reason for that? Probably not, because it's never turned out different than if you pay a whole lot for an investment, it doesn't do great. And all else being equal, if you can get an investment for less money, it ends up being a better long-term investment. And so take a look. As long-term investors, know the key drivers in your portfolio so you can make better long-term decisions. I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.